Thank you very much. At the start of every year, and normally at least 3 months before the start of the year, we have to put a budget together. And I know that's rather complicated, but everyone has a budget in their department. We have budgets. We go to the actuary's report and we look at the cost of claims for the next 12 months. And so we predict what the cost of claims were, and we just divide it over the 12 months. So the cost of claims is $208,000 for this particular example I'm showing you. We have to pay WorkCover a levy rate of the 5.2%, and in this case it comes to about $100,000. We put down here a bank guarantee, and in this case we estimated $10,000. Excess of loss policy we put down at $60,000. Everyone's program will be slightly different based on your history and based on your ability to buy these products. Our claims management fee for this particular case is about $66,000, and that includes the claims data and the claims manager. Every year you're required to have an actuary report. We recommend that you are members of CISA, because that's where you're going to talk to other people who are self-insured and get your ideas and confirm what you're doing. And then we have a component called incurred but not reported. Insurance people will understand that term very well, but from time to time we get claims that someone said they hurt themselves 12 months ago, 2 years ago. Our record is someone came to us and said, I worked with you when I was 19 years old and I'm now 55. And you can never keep your incurred not reported for that length of time, but that's the kind of example incurred but not reported calls. What I've done is over the last 5 years, including 2013, we keep our information up to date every month. The red is what you would pay WorkCover if you were registered. The green is the budget, what we've been through, and the yellow bar is what it actually cost the client updated. So you can start to see the dollar savings for this client is quite, we're talking about $1 million a year. So it's quite substantial. That's one of the most successful slides we do, because in the boardroom people understand that it's just straight savings. You can see and you can measure the budget against the actual. Now the actual includes your outstanding estimates and your incurred but not reported. So even though there's movement in the claims, that should all be covered, and there should be no variation and perhaps only reduction in the actual costs. Rather complicated, but in the actuary report, the purple bar, which is the fourth one along on each year, is what the actuary predicts that your general payments and income maintenance, regardless on the date of injury, will be. That's his best estimate. It hasn't happened yet, but that's telling your director of finances what you're likely to pay out that year. Then we go along and measure it, and we measure it by the black graph. The blue is general payments, the red is income maintenance, and we total that up and it comes to the black. Now my second trend line is rather skew with, because I've included 2013 in there, so the angle of the trend line is a bit much, but nonetheless you can see from the actuary's information, as this client progresses, his payments are coming down, and the trend is that he's coming down as well. We measure the number of umping claims we have at any one time. When we started this with this employee, we started with over 100 umping claims, and over the years we manage the claims as they come and they get reduced. This client currently has 6 umping claims, so from just under 100 to 6. That's been a remarkable achievement by this client. Once again, in the actuary report, in the first bar, the actuary will estimate what your liability is going to be, the outstanding estimates and the incurred but not reported. We tend to fix the incurred but not reported because that's his valuation, and the cost of the outstanding claims varies every month as you go through. So you can see we started off a little under 400,000, and by December 2012 we're under the $300,000 mark. So we got measurements all the way through. We measure income maintenance. Income maintenance, of course, is time lost from work. So when we started with this client in just over 4 years ago, we had in 2008 it was they paid out $129,000 in income maintenance, and last year we paid out about $10,000. So everything's trended, and everything's been kept up to date. If there's additional payments put back to a claim, it goes back to the year that it was incurred. This is lump sums that have been paid out to this client. Now it includes redemptions, and it includes Section 43s, which is permanent impairment disability. If we had a chat to the worker and we wanted to settle his outstanding income maintenance and his medical expenses, that would be a redemption, and we're able to do so. The employee may carry on working, or he may choose to leave his employment. It depends what you want to happen. So over the last 4 years, these payments have reduced. In 2012 there was none, and perhaps it's a bit early, but the trend is certainly reducing. We also measure by remuneration, and the term remuneration is salary and wages plus your contribution of super plus any other payment you make to a WorkCover. So generally speaking, your remuneration increases every year. WorkCover dreamed of that term because they could collect more levy off you. Most insurance policies are just salary and wages, but not WorkCover. They find a way of increasing it. So on the basis that your remuneration increases every year, this slide shows that as a percentage, the actual cost of self-insurance, including outstanding estimates and incurred but not reported claims, is dropping. There would be an excuse to say it could increase, but in this case it has dropped. We also measure, and a lot of this information comes out in actuary report, and you have to keep your actuary as an independent evaluation of your outstanding liabilities. You don't want to influence your actuary. You can present your cases as your claims managers do, but it's an independent evaluation, and your board would appreciate that. If you compromise your actuary, then you're just gone. You've got no credibility. So the actuary is independent to anything you do, and you rely on his report to verify the journey that you're going on. This slide is your total remuneration once again. On the total incurred costs, that's paid to date, what you've paid to date for claims, and outstanding estimates shown as a percentage. And so 2012 came out at 0.062%. They're strikingly small figures, and we've had to go that far to show it in the graph. I just can't round it off at 1 or 2 decimal points. The other thing we do is we track the amount of financial guarantee you're required to lodge with WorkCover every year. And as your liabilities decrease, so does your financial guarantee with WorkCover. In this case, it's decreased. I like to think the actuary made a mistake in 2010 and 2011, but nonetheless, it works out well. There is a minimum financial guarantee you have to pay, or a source, and that's $790,000. You can't get below the minimum. If the true liability could be shown in this graph, it would be $540,000. That's what the actuary report said, but WorkCover have a minimum you're required to lodge with them. With permission, I pinched this graph from Sizer. Robin Shaw is the manager of the self-insurers of South Australia, and he put this graph up at last month's meeting. What it simply shows is that over the last 11 years, at the very top, 11 years ago, WorkCover had 77.7% of the total liabilities. Today, in the last line of the graph, they have nearly 85% of the liabilities. By comparison, self-insurers started off with 22% of the liabilities, and last year they had 15% of the liabilities. Now, to put that in some perspective, the remuneration for all self-insurers has pretty well stayed the same. It hasn't moved. So self-insurers manage their claims better. Now, what is a safety program? Many solicitors say to me, I want to see what a safety program looks like. And there's 5 components to a safety program under the Code of Practice to be self-insured. It starts off with your commitment that's shown in your policy. Then you have a planning mechanism. What are you going to do for the next 12 months? You then implement that plan. During your course of implementing that plan, you will measure it, you will audit it. And then at the end of the year or the end of the period, you'll review what you've done. You'll sit down and say what was successful, what wasn't, how can we improve it. We're not doing the same audit time and time again because we always come up with the same result. We're going to measure another component of our programs. So that is your safety management and your injury management program on one page. It has down the left-hand side the 5 components I've just set out. On the top line, you'll have your policies, and then you'll have all your supporting policies and procedures. As we go down to your planning mechanisms, the right-hand one is your training program. You will set out your training program, exactly what you want to deliver over the course of the next 12 months. It will have job descriptions and it will have the courses you're going to send your employees on. Your safety manager will probably be a little exuberant, and when he turns around and costs it, your director of finance will say, reduce it, but he will know exactly how much you're going to spend. Then is the implementation of your total program. And as I said before, in the standard 4, in the 4th line, is your internal audits. Are you meeting your objectives and target performances and your corrective actions? In other words, you do an audit, you can't fix it straight away, everything goes on your corrective actions report, and you'd want to be knocking that off on a regular basis. And the last line shows you exactly how to review your performance during the year. It's something you do. You want to be better. You want to improve your workers' comp. You want to improve your safety. Your ideas go there, and then they go back into your planning process for the next year. Also on that slide, a general manager or managing director will start to identify what reports he wants of your safety specialist or your injury management, and he will start tracking it. He will start asking for these reports, such as training. Are you implementing your training program against your plan? And so you'll get some leverage off there. You're required to give every year to WorkCover your audited accounts, and they're probably included in your annual report. You're required to forward your actuarial report to WorkCover. The renewal process is for a maximum of 3 years, and of course you have to complete complying with the Code of Practice for your OHS and injury management program. We do provide information sessions, and we have provided information sessions to yourself, to your organisation. We do review workers' compensation and injury management. We audit and we review against the regulations. We do assist you with policies and procedures review, and we make them, or suggest that they're compliant procedures. And the ongoing safety and injury management support and mentoring of your staff. We've had a couple of instances where we've applied for grants. EML have a grant process, and you can get up to $60,000 from there, and we've ended up writing the grant process and asking the employer to sign, and then they have to make a contribution, but it's $60,000 there, and that will be available again from the 1st of March this year. Thank you very much.
Thanks very much, Col.